On one hand, you have hedge funds who are selling more stock than there is issued. On the other hand, you have Wall Street bet investors refusing to sell. Guys, if you've been following the news in any way, you know that GameStop's share price is going on a little bit of a mad one. The fact that it has gone up 1,784% just in January alone shows something is going on in a really crazy way. Now, those of you that are new to my channel, my name is Jag. I post all kind of videos on stock market, so if you want to see more updates like this, make sure you hit that subscribe button down below and hit the like button while you're at it, because it really helps out the channel and it motivates me to make more videos for you. Quick disclaimer, this video is made for entertainment purposes. I'm not a financial advisor. This is not financial or legal advice. Go get that somewhere else from a suitably qualified professional. To bring us up to speed, GameStop is a retailer in the United States of video games and consoles and other video game related accessories. In the UK, we have an equivalent called Game. GameStop has pretty much been slowly declining in revenue as more and more people are shopping for their games online on places like Amazon and are actually also downloading their games directly from the PSN store or the Xbox store. As GameStop used to make a lot of money when people used to sell their games in bulk for pennies on the dollar, and then GameStop would then flip those games over for a nice buck. But that model is slowly dying out as more and more people are digitally getting their games, so there's less disc to actually trade in. And hedge funds saw this opportunity, but he's on a decline, and the share price does not actually reflect the value of the company. So hedge funds thought, hey, this company is going to be on the same path as Blockbuster and the likes of Toys R Us, where literally digitalization ruined their whole business model. So these hedge fund guys shorted the stock. In other words, betting it will go down. But here's where the tables turned. GameStop started getting a load of positive news around their company, which shows that their business model may be turning around a little bit. In June 2020, GameStop reported a 519% increase, a jump of online sales when their physical stores closed or actually forced to shut down. And then just 2 months later, Ryan Cohen, who is the billionaire founder of Chewy.com, the pet food company, bought an entire 9% stake in GameStop. Ryan stated that he's going to turn this company around, make it the Amazon of games, and just really revolutionize and fix up the company. Guys, this alone caused a surge in the stock price of 28%. And the good news of GameStop just kept coming in. It then announced in October 2020 that they will be getting a multi-year strategic partnership with Microsoft. And then their earnings report came out, which showed another jump in online sales. And then the pet food guy actually bought in 13% of the company, increasing his actual stake in the business. And then some stuff started to happen. 4 months ago, some users on Reddit saw some fundamental secrets about the stock which could make it potentially skyrocket. There's a user that found out that GameStop was the most shorted stock in the entire American stock market. In fact, there's more shorts against the company than there are actually stocks issued. I'll explain this a bit further, but this is kind of like a little short bubble. Could have meant that there was some profit to be made when there's sudden good news coming about the company. What was done and what is potentially still being done is a short squeeze. So let me just run through how this whole thing works. What is shorting and how it actually works and how you can actually make money by shorting? Well, they borrow the stock, then sell it, then buy it back after the stock value has fallen. Price and what they sell for and what they buy for is the actual profit that is made. So for example, let's say they short a company at $100 and then the stock price falls to $50. So they have just made $50 a share. Now the thing about shorting is that it is pretty much unlimited risk. I made a post about this a couple weeks ago on my Instagram page before this whole GameStop thing, that you should probably avoid shorting at any means. The reason is that there's no maximum amount a share in a company can go higher. If you buy a stock normally, you know that if the company does really poorly, it can go to zero and potentially you can lose your money that you put in. Now the zero is the maximum, but with shorting a stock, it's the reverse. So you're betting against the company going higher, and now there is no ceiling towards that. It can keep going higher and higher and higher, and you can potentially lose a lot of money, more money than you actually deposited. Now let's run through a loss-making scenario for the hedge fund. Let's say GameStop went to $400. The short seller who shorted at $10 a share would have to buy back the shorted amount at $400, causing a $390 loss per share. As the stock price keeps increasing, so will their losses. How does shorting work in real life? Well, let's say James happens to own a million shares of GameStop. The hedge fund goes to James and says, hey, you have a million shares, can I borrow these million shares for 2 weeks or a month? And says to James, hey, I'll give you these back 100%, you will get your million shares back. I just want to borrow it for a month. The hedge fund borrows those shares and sells them straight away. If I was the hedge fund, my plan would be that, hey, the stock's going to go down and I'm going to just buy back the shares at that amount, whatever that is, and I'll be giving James his 1 million shares back but keeping a large chunk of profit. Now the key is that I will have to buy a million shares at the end of the month, because I already told James that, hey, I will be giving you this amount back no matter what happens. Now this is actually what happened in the GameStop scenario. Wall Street users found out that hedge funds were shorting this stock heavily. Everyone realized that, hey, these hedge funds have to pay back those million shares they actually borrowed for the shorting process at whatever the cost. So everybody started buying it, forcing the price to go up, and the hedge funds are forced to buy it at whatever price to cover their positions. One thing you have to remember, that the short sellers are borrowing shares at an interest rate. But the more the price goes up, they can't afford to pay because they don't have enough liquidity to cover it. So they'll be forced to close their positions, causing them A, to lose money, but B, to actually increase the price even more because more people are actually buying it. And then the next hedge fund comes in and they're in the same process. You know, this price is too high now. They have to cover their short position. Now they are forced into buying loads of GameStop shares, causing the price to increase again, and it just keeps going on, causing this mad cycle of the price increasing. Also, as there is a limited amount of shares, stockholders, which are now Wall Street bet users, can just keep refusing to sell to the hedge funds. It's just simple supply and demand. They have a product which is a share of GameStop. The hedge funds want to buy that. They're going, nah, it's not happening today. So what's happening is that tons of retail traders are buying the same stock, causing it to rise rapidly, squeezing all the short holders out of their positions and making a lot of money along the way. Retail investor Deep Value, who actually discovered most of this, has made a gain of $31 million. That's in profit, $31 million in profit. It's amazing to see that a guy in his bedroom is taking on the big hedge funds and making a lot of money along the way, just by the power of Wall Street's bets Reddit form. It's important to know that this investment is probably the most riskiest investment people are making. Yes, there is a ton of people making money, but fundamentally speaking, GameStop as a company is probably not worth $20 billion right now. Now, when I saw all this happening, I was going to get involved and actually buy some stock and actually make some sort of investment in GameStop. Then I took a step back and realized, is this part of my investment strategy? Can I hold GameStop for more than 10 years and be happy with it? And the answer to both those questions is, of course, yes, no. It's not. So I decided, hey, I'm not going to be taking part. This is probably the most speculative bets that people are making, and I don't really want to be part of that. You don't really know how much the stock price is actually going to increase, when you should exit. There's a whole load of questions that we just don't know, and I'd rather have control over my investments and know that, hey, I'm not going to lose money down the line. So I'm avoiding it. But it doesn't mean that people are making money. People are making huge amounts. It just personally doesn't fit in my wider investment strategy. Now, if you want to know how to invest and identify undervalued companies, then check out my video on how I made around £5,000 by investing in 2 undervalued companies.